Mistake number one, trying to time the market. Mistake number one is the silent killer of beginner portfolios, trying to time the market. On paper, it sounds perfect. Buy low, sell high. But here's the kicker. In reality, nobody can pull this off consistently. Not you, not me, not even Wall Street pros with research teams and decades of experience. The stock market doesn't move in neat, predictable patterns. It reacts to everything: company earnings, political decisions, global conflicts, even investor moods. Some days good news makes stocks fall, and bad news makes them rise. Short-term market moves often look random, which makes betting on the right moment less like investing and more like gambling. And here's the twist. The price of getting it wrong is brutal. If you invested $10,000 in the S&P 500 back in 1995 and just left it alone, today you'd have over $200,000. But if you missed only the 10 best performing days in that entire 25-year period, your returns would be cut in half. The best days almost always come right after the worst ones, when fear is highest and most people are sitting on the sidelines. Think of it like skipping your friend's birthday party because you assume it'll be boring, only to hear the next day it turned into the wildest party of the year. That's exactly how markets work. If you sit out during the rough days, you usually miss the big rebounds too. The lesson: wealth doesn't come from timing the market. It comes from time in the market. Stay invested, let compounding do the heavy lifting, and ignore the urge to play fortune teller. If you don't want to miss the next money-saving strategy, hit like, subscribe, and turn on notifications right now. That way, you'll always stay one step ahead of these investing traps. Mistake number two, panic selling during volatility. Mistake number two is panic selling when markets get rough. This one hits hardest because it preys on emotions. When you see your portfolio dropping day after day, your brain screams, "Get out now before it all disappears." But here's the truth. A drop only becomes a real loss when you sell. Look back at March 2020. When COVID-19 shut the world down, the S&P 500 fell nearly 30% in just 3 weeks. Headlines shouted global recession. Businesses were closing. Fear was everywhere. Many beginners bailed out, thinking they were protecting themselves. But within months, the market had recovered. Within 18 months, it had doubled. The people who panicked missed one of the fastest rebounds in history. This story isn't new. In 2008, during the financial crisis, stocks fell more than 50%. Countless investors sold at the bottom. But a few years later, markets not only recovered, they went on the longest bull run in history. Those who stayed invested built wealth. Those who jumped ship locked in devastating losses. Picture it like unbuckling yourself and leaping off a roller coaster at the steepest drop. It feels terrifying in the moment, but if you just hang on, the ride always smooths out and ends safely at the platform. The ones who get hurt are the ones who can't hold on. The fix? Build an emergency fund so you're never forced to sell investments to cover bills during a downturn. And remember, crashes are temporary. The market has survived wars, recessions, and pandemics, and every single time it has come back. Mistake number three, chasing hot stocks and fads. Mistake three is chasing hot stocks or the latest investing craze. This is the classic trap of FOMO, the fear of missing out. You hear everyone bragging about the stock or crypto that's going to the moon, so you jump in, usually right before it crashes. The meme stock mania of 2021 is a perfect example. GameStop and AMC skyrocketed. Because of online hype, early buyers made fortunes, but most who joined late lost big when reality set in. The same thing happened with Dogecoin. Massive hype, massive crash. And it's not just recent. Back in the 1990s dot-com bubble, companies added .com to their name and saw stock prices soar 70% overnight, even with no business model. A few years later, most of them were worthless. A good way to picture this is showing up late to a party. By the time you arrive, the food's gone, the drinks are warm, and the fun's already over. Early arrivals may have had a blast, but latecomers leave disappointed. How to remedy this? Stop chasing hype. Build a diversified portfolio that grows steadily instead of gambling on fads. Index funds and ETFs give you instant diversification across hundreds of companies and protect you from being wiped out by one bad bet. Mistake number four, not diversifying investments. Mistake 4 is failing to diversify, putting too much money into one stock, one sector, or one type of asset. It feels exciting to go all in, but it's a dangerous bet. Enron in 2001 is the clearest lesson. Employees who invested their entire savings in company stock lost everything when Enron collapsed. Similarly, in 2008, investors who concentrated only on bank stocks or real estate were crushed when both sectors fell apart. It's like carrying all your groceries in one flimsy bag. If that bag rips, everything crashes to the floor. But if you spread them across several sturdy bags, even if one breaks, you save most of what you bought. Diversification works because assets don't all move the same way. When tech stocks fall, healthcare or consumer staples may rise. When U.S. markets dip, international markets may hold steady. A mix cushions the blow. The fix is simple. Use index funds or ETFs. An S&P 500 index fund instantly spreads your money across 500 companies. If one fails, it barely dents your portfolio. Diversification is your safety net. It won't make you invincible, but it ensures one mistake never wipes you out. Mistake number 5, ignoring fees and costs. Mistake 5 is ignoring fees. Beginners think 1% here, 2% there, doesn't matter. But over decades, fees can destroy your returns. Here's the math. Invest $100,000 for 30 years. With a 2% annual fee, you could end up with hundreds of thousands less than if you'd chosen a fund charging 0.05%. That's the silent tax on investing. It compounds against you. John Bogle, founder of Vanguard, called high fees the enemy of investors. He compared them to termites eating away at a house. Slowly and silently, they cause devastating damage. Or picture it as running a marathon with an anchor chained to your leg. At first, it doesn't feel so heavy, but mile after mile, it drags you further behind until you can't keep up with the runners carrying nothing. The fix? Check the expense ratio of any fund before investing. Keep it under 0.2%, ideally under 0.05%. Index funds and ETFs are the cheapest, simplest way to grow wealth without losing it to fees. Mistake number 6, investing without a clear goal or plan. Mistake 6 is investing without knowing what you're aiming for. Beginners often throw money into Tesla, crypto, and gold all at once, then panic when everything moves differently. Without a goal, every decision feels random. Now compare that to someone who knows their goal, like for instance retiring in 30 years. They might invest 80% in index funds, 20% in bonds, and stick to that plan. Short-term swings don't faze them because the destination is clear. The best comparison is driving without directions. If you don't know where you're going, every turn feels wrong. But with GPS set to your destination, even if traffic slows you down, you know you're on the right path. The fix? Define your why. Are you saving for retirement, a house, or education? Once you set the goal, build a portfolio that matches the timeline. Clear goals remove panic and give every investment a purpose. Mistake number 7, expecting to get rich quickly. The final mistake is treating investing like a get-rich-quick scheme. This mindset destroys more portfolios than any bad stock pick. Warren Buffett said it best. The stock market is a device for transferring money from the impatient to the patient. Take Amazon. In 2000, a $1,000 investment in Amazon would have lost 90% of its value within 2 years. Many gave up, but those who stayed invested saw that same $1,000 grow into more than $60,000 over the next 2 decades. Wealth didn't come overnight. It came from patience. Think of investing like planting a tree. Dig it up after a month and you'll think it's dead. But water it. Give it sunlight and let it grow year after year. And eventually it becomes massive. The solution: reset your expectations. Investing isn't a sprint, it's a marathon. Real wealth comes slowly, through compounding and discipline. The impatient get burned. The patient build fortunes. If you found this valuable, make sure to like, subscribe, and turn on notifications so you never miss the next deep dive into money, investing, and building long-term wealth.